In our strategy, we use a 5-phase framework to manage risk across the cycle. We are not predicting headlines. We are tracking signals and sequencing risk as conditions evolve. Survival comes first, opportunity comes second. Today's setup is a classic tension. Markets were very close to all-time highs. Good news hit across geopolitics, earnings, and inflation pressure, and yet price rejected hard. This episode is based on a video from StockedUp titled "Wall Street is Selling." They focus on intraday structure, retail flow, and key technical levels. You should watch the original for the full technical breakdown. Our role here is to translate the signal into our strategy. The key takeaway is not a single headline. It is how markets reacted to good news. Despite de-escalation risk and strong earnings, price failed. That reaction matters more than the news itself. Retail traders are buying aggressively. Flows are at the highest level in 9 months. At the same time, institutions appear to be selling into strength. That divergence matters late in the cycle. In our strategy, this is familiar behavior. Retail enthusiasm tends to peak near resistance. Institutions reduce exposure when upside becomes asymmetric. That increases fragility even without bad news. This episode hits 3 core signal buckets: breadth and positioning, liquidity behavior beneath the surface, risk appetite versus price confirmation. When retail buys upside aggressively and momentum slows, dealers hedge by selling into strength. That creates overhead pressure near highs. Price can roll over without a catalyst. Oil fell on de-escalation headlines. Semiconductor earnings were strong. Inflation pressure eased, but liquidity momentum did not improve. This fits Phase 1, drifting toward Phase 2 behavior. Melt-up conditions still exist, but multiple compression risk is rising. That is a different environment than early expansion. This is not a crash call. It does not invalidate participation with discipline, and it does not mean upside is impossible. It means risk must be managed differently. Silver's sharp after-hours drop matters, not because silver is bearish, but because volatility is entering crowded trades. That is how fragility shows up. Late cycle moves do not fail slowly. They fail through volatility expansion first. Stops trigger faster than new buyers step in. That is why volatility matters here. This is educational commentary only. It is not financial advice. We tighten exits. We reduce size near resistance. We slow deployment speed. We treat strength as something to manage, not chase. We do not flip bearish by default. We do not abandon the framework. We do not force timing, and we do not react emotionally. Key levels matter as tests of positioning, not as predictions. Acceptance versus rejection is the signal. Process matters more than precision. Near-term upside is still possible, but the probability of chop and compression has increased. If rejections persist, timeline risk compresses. That is the adjustment. Watch how markets respond to good news. Track retail flow versus price confirmation. Monitor volatility in crowded trades. Pay attention to failed breakouts. Broad acceptance above resistance, improving breadth beyond a few leaders. Falling volatility alongside rising price. Those would reduce this signal's weight. We do not need to be early. We just cannot afford to be late.